All of the market focus is on the upcoming Fed decision, with the outcome capable of inspiring a shakeup in either direction. As we head into the event risk, the broad consensus is calling for a rate cut of 25 basis points, which would be the first rate cut in over 10 years. This would take the Fed funds corridor rate to between 2 and 2.25%. The fact that this will be the first cut in over a decade, with monetary policy still sitting at emergency levels, is not an encouraging sign for the real economy, and many fear the Fed moving in this direction is a sign of recession to come. Some have been calling for a 50 basis point cut at today's meeting, which will play into the market reaction once the Fed communicates its message. And with no update to the committee's projections at today's meeting, it will be up to Fed Chair Powell to deliver the bulk of the message. If the Fed pushes forward with a 25 basis point cut, there will be room for the dollar to rally on this alone, as those calls for 50 basis points are priced out. At the same time, Powell could easily come right back and strike a dovish chord that plays into ultra-dovish expectations, with a clear signal that more rate cuts are forthcoming. A lot of this will come down to the Fed's language on inflation, and if the central bank looks to focus on subdued inflation as a hindrance to the growth outlook. If it does, this should be something that satisfies the dove camp despite not getting a 50 basis point cut. Overall, the Fed's message should be one that justifies the need for a move back to rate cuts on the back of slowing growth against a backdrop of subdued inflation and elevated uncertainty. But again, how much the Fed chooses to focus on subdued inflation will offer a hint at just how dovish the Fed wants to be going forward. And so today's decision comes down to this question. Will the Fed send a message that this first cut in over a decade is more of an insurance cut to give the central bank some cushion as a precaution against any future downside risk within a still recovering economy? Or will the Fed send a message that today's cut is a more serious reaction to what it sees as dangerous waters ahead that will likely necessitate continued moves back in this direction? On the surface, a Fed decision leaning more dovish will open the door for an upswing in dollar selling as yield differentials move back out of the buck's favor, while also potentially fueling yet another run to record highs in U.S. equities if investors are still inclined to want to play the game of buying at every sign of accommodation despite the dangerous message accompanying such accommodation. If, on the other hand, the Fed can't outdove market expectation and comes off sounding more upbeat, yield differentials will move more aggressively in the dollar's favor, inspiring yet another wave of dollar demand, while at the same time likely triggering a run for the exit doors in the U.S. equity market as investors grow concerned that the game of bowing to the will of investors at every turn has finally run its course. That's all for now.